Okay, let's get started. Good afternoon, everyone. Thank you for joining us for this webinar. This is Futures Options Replay, and we are going to get started on the platform in just a moment. Let me just do some introductions and some disclosures before we do that. Brandon, we're doing
Oh,
Future, right? Did
that's
I
the wrong
call it
one.
the wrong one? Okay, ignore the title. The presenter is correct. It's Brandon Wendell, but this is a Futures Options Replay. So we're going to take a look at examples of trades that could have worked or not worked, last week, and see what was going in the markets and what type of strategies you could have used. So this is a great opportunity to ask Brandon questions about trading activity, especially when it comes to futures options. And we're just going to get started in just one moment. For those that don't know me, my name is Jesus Nava. I'm the Director of Client Training and Education right here at TradeStation Securities. Every symbol and idea that we talk about in this presentation is for educational purposes only. Keep in mind that trading online is risky and it should only be done with the risk capital. And any example or any demonstration of past performance is just that, an example. There's no guarantee of future results. If you need additional information on these disclosures, go to tradestation.com/important-information, and you'll find all the disclosure information there. All right. Before I pass the microphone over to Brandon, I wanted to take this opportunity to talk a little bit about the TradeStation Masterclass. If you haven't heard, we are going to meet in person in Chicago, Illinois. And if you have the opportunity to join us, it'd be great for us to meet there. It's very close, September 24th. That is next week. So if you're in the Chicago area, great. And if you can arrange travel in a week, that's also great. But I wanted to do a last effort to just invite everyone here. I have shared a link to this registration page in the chat. I'm going to do it one more time. Okay, so that's the link for information on the TradeStation Masterclass. And I'm also sharing with you a promo code that will give you $100 off towards the ticket price. And also, one thing that you probably should know is that whatever it costs you to attend the masterclass in terms of the ticket, whatever you pay for the ticket for the masterclass is going to be refunded to you as a commission rebate. Something to think about when it comes to attending these live events. All right, let me go ahead and switch over here to our presentation. As I said earlier, our guest today is Brandon. If you've been in one of his presentations, specifically the Futures Options Replay, it's a very practical presentation. As I said before, if you have any questions, make sure that you send those to the chat. Thank you, guys. Brandon, I'm going to just mute my microphone and the floor is all yours. Okay.
All right. Thank you. Let me go ahead and share my desktop. There we go. And there it is. That is the Futures Options Replay Key Insights and Strategies. Brandon Wendell, Chartered Market Technician, as it says there on the board. And thank you, Jesus, for inviting me to speak with everybody here. And if you have any questions, go ahead and type them into the chat. I'll be monitoring the chat, as well as if you got questions beyond this, you can always email education@tradestation.com, and they'd be more than happy to get the questions answered or forward them to me, whatever we need to do. As you already mentioned all this stuff, I am not an employee or affiliated with TradeStation. I was just invited as a guest to be able to speak to you about options on futures because it's something that I trade on a regular basis. So my background, I'm a chartered market technician, which is a master's degree in technical analysis. I've been doing this probably for 30 years, I guess now. Got involved in the markets, 1996, 97. I actually got my Series 7, and I think in 96. Anyway, I was a hedge fund member. I made a hedge fund trader and then left the back office of the brokerage, left the hedge fund field, and just traded for myself. It's much easier that way, much more relaxed. And I do education and mentoring as well. Anyway, that's enough about me. Let's talk about the markets. So basically, what we're going to talk about is some of the different strategies that I was able to employ in the markets on a couple different securities. And we're going to see their outcomes, both wins and losses, because that's the way the markets go. Sometimes things work out the way you want. Sometimes they don't. And we'll talk about some of the decision-making processes that go into what I'm doing when it comes to choosing these securities and these, not just the securities, the underlying, but the actual strategies as well. We've talked about them before. There's actually a masterclass series that we did a while back with, what's called Yeah, there was a masterclass. There's a whole series on options on futures as well as future spreads that I did with Jesus. So you can go ahead and watch the recordings. They're available on the TradeStation website. If you're not familiar with that, by the way, let me go find it real quick for you. If I can find there it is. My browser, I got so many things open here. But if you go to TradeStation.com and under Learn, you'll find Masterclass. And you'll be able to find, as you scroll down through the masterclass, you should be able to find those masterclass previous recordings that I've done. There it is, future spreads and options. And there's a whole bunch of lessons there. There's actually 6 of them altogether. 3 of them are primarily future spreads. 3 of them are options based, and actually a couple more overlapping a little bit. So anyway, that's available to you for more education. As you can see, I'm using TradeStation Futures Plus, which is the platform necessary to trade options on futures and futures spreads. So we can still do analysis on TradeStation. As you can see, I'm using that as well, the regular platform. And not only that, but I can also go into OptionStation Pro and I can analyze on options on futures. You can't place the trades. You can only place the trades on Futures Plus. But if you want to do some analysis and you're familiar with the platform OptionStation Pro, that's where you can go ahead and kind of use the price slices and manage theoretical positions. I was actually doing some other trades here in equities, but like I said, if I were to look at CLV 25, that's crude oil, current contract, you can see that I have the ability to analyze but not trade the options. So if I were to click on this, it'll give me that warning saying, listen, you can do this analysis, but you can't trade it. You got to go to Futures Plus. So what we need to do, first of all, is change that to analyze trade rather than trade, and that'll help me out. So going back to last week, or actually not even last week, but a few weeks ago, where was I here? Again, I got too many things open. There we are. I was looking at corn because why not? No, actually, what I did is on TradeStation, I have a strategy that I created many years ago, and I teach it in my courses called the 889 trading strategy. And I found it to be very valuable to identify potential opportunities in the markets based on Elliott wave theory, if you will. If you're familiar with Elliott wave, I don't want to get too intense into that or make this a lesson on it because that's not our purpose, but Elliott wave basically describes the market moves in waves of 5, where you have 3 impulse waves and then 2 corrections. And that's how trends are usually built. You get these impulses, corrections, impulse, correction. So again, I go back to TradeStation and I happen to be on platinum here, but it could be any security. It really doesn't matter. And any time frame. And basically what I look for is the most powerful of the waves. So let's say we go out to, not that, let's go to a daily chart and we can just take a look at this current trend that we're in. And we can see, it looks like it started here in April. We've got this overall big trend going up. And typically you could break those down into 5 smaller components. And that's where the trick comes in because there's actually only 3 rules for Elliott wave, but there are lots of guidelines. And that's what gets everybody in trouble, is trying to fit everything into the guidelines. So again, I'm not going to go too much into depth in that now, but basically what the 889 strategy attempts to do is I try to capture wave 3, which is never the smallest wave, and it is often the largest. Okay, so it's never the smallest on its own, but it's often the largest wave out of the 3 impulse waves, which basically impulses are the major moves of the trend. And that's what I'm trying to do, is just simply capture that 3rd wave, which often originates in a balance of that 89 EMA, but there's other characteristics and pieces to it as well. So what I created was a scanner that I can run through and see, or even just manually go through. And I did this on a 4-hour time frame. Oops, I did 2-minute, it'll work on 2-minute, but I don't want to go that small. So typically when I'm trading options, I'll use hourly, 4-hour, 8-hour, or daily type charts. And I can run through the continuous contracts by having it linked, and I look for certain setups in my charts. And it just so happened, as I was running through these on corn, I had a particular setup I was looking at. And this is actually showing a little bit after the fact. The time I looked at this was August 27th. That was the entry time for the chart. And you can see on August 27th, let's do it this way. I'll go out to the chart. Come on. There we go. And it was CZ25. All right. And you got to be a little bit careful too with the symbols. If you haven't figured it out by now, TradeStation uses the pit symbols, while TradeStation FuturesPlus often uses the electronic symbols. It's not that big of a deal if you know what they are, but if you're not sure, it could throw you off a little bit. But it's easy enough to look them up, as well as the options codes. If you go to the CME website, you can look for the contract directory. Again, let me go out to a browser to show you what I'm talking about. I'm actually logged into the CME website, but for another reason right now. But simply going to the cmegroup.com and doing a search, you look for contract directory. So clicking on that, there's contract directory and calendar tool. You can always bookmark it. This is where you'll see the symbols for, it'll show you the electronic symbols and the option symbols. So for instance, hang on a second. What do I use here? Bear with me for a moment. Can't remember what I used for my zoom in. Alt Z. There we go. Okay. All right. So right here, as I zoom in, you can see corn, for instance, the electronic symbol is ZC for the future. The options are OZC. Another trade that I did was gold. So when I go to metals and again, zoom in, you'll see that gold is actually the OG. All right. Now, basically, it's something that I teach in my courses. So you'd have to contact me a little bit for that information. I don't give that out right here for now for the custom scanner. It's relatively simple, though. You have to understand the strategy, too. So it takes a little bit of time to be able to go through all that. But basically, again, let me go back to the chart. And what I saw on the 27th, which is right there, I marked it when I was getting into the trade, was prices were returning back to the 89 exponential moving average and looking like they were going to bounce because I have here what's called an area of demand. I don't trade traditional support and resistance because I came from an institutional background where I was institutionalized. No, I'm kidding. I probably should have been, but no, I worked for the institutional trading desks and I saw institutional order flow. And basically what I'm looking at now is where are the institutional order leftover orders going to be? So I'm looking for imbalances of buying and selling pressure. And here's an imbalance with lots of buying pressure, no sellers. So prices are likely to bounce there because there's leftover orders that are trying to get filled. Another example would be right here, where we have basically prices did what's called rally-based rally. See the powerful move up. And even to a lesser extent, we had one right here. Whoops, come on. It did not go right. I don't know why I won't draw. Anyway, right here, where prices dropped based and had a small rally. And you can see we bounced from that area when prices returned. So I was looking for a bounce around 404 to 406. Okay, it's an area that I identify because it's hard to pick an exact price. You can much easier. It is much easier to identify a range where prices are likely to bounce rather than the exact price. So that's what I did. And you can see prices actually did rally from there. Unfortunately, if you hold on too long, it's still going up, but it might have come back on me. Now, the other thing that I have to keep in mind, and we'll talk more about that, is volatility. Now, when you're looking for volatility on stocks, it's pretty easy because you have indicators. For instance, I can go into add study, and under I, we have implied volatility, all options. Heck, you can even just go ahead and look at OptionStation Pro, and you'll see right here, theoretical values, but not theoretical, sorry, it says theoretical value, but that's actually right here. This is showing implied volatility for those options. Unfortunately, it's not giving me anything for this one. Let's see, next series, the X November contracts. There you go. See, these are implied volatility numbers right there. So that's what it shows you. The problem is a number by itself doesn't necessarily mean anything. Is that number high or is it low? Is volatility high or low? Why do we care? Because of the vega of options. When volatility is high, options are relatively expensive, and therefore you want to lean more towards credit spreads, where if they're cheap, with the volatility being low, you probably want to lean towards buying. So this is, unfortunately, it's okay, but I can't really use that to gauge whether or not we're relatively high or low. And back on the chart, I can't use this implied volatility all options because it won't show me. It doesn't give you the data on futures. So instead, I've decided to use a couple of studies that also give you a little clue as to volatility. And what I did was I used Bollinger Bands because that's measuring movement away from an average, which is volatility. Volatility is how far you're likely to be moving away from an average price. And what I've chosen here is I've got the Bollinger Bands I'm putting on, and I also got Bollinger Bandwidth as a volatility indicator. So we can see when I came into this area where prices were about to hit my demand zone and bounce, volatility had taken a bit of a dive. The bands were contracting. So that means that options were relatively inexpensive, and therefore a debit strategy might be a better play, because not only could I profit from a bullish move if I picked a bullish debit strategy, but I would also profit from volatility increasing as well. And you could see volatility did increase. Unfortunately, I held on too long and I got out when volatility had collapsed, because you see, I waited a little bit to get out of that. If I had timed this right and gotten out near the peak of volatility and near the peak in price, I probably would have maximized my potential profit. We can even check now, because currently volatility is almost back to where it was at the entry spot for this position, isn't it? You can see the entry was right about here, and volatility is a little bit higher now. So let's examine this trade and see what happened here. So for the trade, basically, this was the same chart on the day using FuturesPlus. I think it's a little bit more powerful to use TradeStation for the charting than it is FuturesPlus, but again, it's a personal preference. I did them on both anyway. I was also using RSI, but I use my RSI as a momentum indicator. I do not use the RSI traditional method because it doesn't work as well. It's always lagging a little bit. What I'm doing is I'm using it to measure momentum. And if we have too much momentum, prices are likely to continue in trends. Or if we see weakness, for instance, here at the end, you have what's called a negative divergence, where prices are making highs without the momentum needed to maintain those highs, and prices collapsed into my demand. When they fell, you'll notice I don't use the traditional 70-30 for RSI. Let me bring it back onto my live chart here. I was just showing you the bands, but I'll bring up RSI here, and there it is. Okay, so there was a divergence back here. There was another one just before it went sideways. But basically, what I'm doing with my RSI, if I double click on it, you'll see my inputs are a little different. I use 40 for oversold, 60 for overbought. And I'll let you in a little clue here. When you are in a bullish trend, you will not become oversold, because oversold implies that there's a lot of selling pressure, and you should not see any selling pressure in a strong bullish trend. Notice it barely peaked below 40 for just one moment, one candle. The rest of the time in that bullish trend, we were not below 40. If you're below 40, you're not in a bullish trend. You're probably bearish. And in a bearish trend, but you don't really see much of it here because I have to go back further. But in a bearish trend, typically you won't go above 60 in the RSI. So you won't become overbought in a downtrend. So people are trying to buy oversold and sell overbought. It doesn't work too well if it never hits. So at the time on the 27th, we were coming into demand. RSI was above 40, meaning that we were not oversold. We didn't have enough bearish momentum to break through that demand. Volatility was diving. So a bullish debit strategy would probably be the best thing to do. So looking at the chain, I used the October chain, and honestly, I probably should have gone out further. At the time I did this, you can see there were 30 days until expiration. It was in August when I was putting in the trade. But here's the problem. I just said I would more likely do a debit spread. If I'm doing a debit spread, one of the things that's going to work against me is theta, right? Time decay. And time decay explodes exponentially when you get within 30 days until expiration. Doesn't matter what kind of option you're trading. So optimally, I should have been choosing a further out expiration. So that way, when I exit the position, I still had 30 days or more until expiration. So I should have been trading the November or even December options. Notice they're still based on the same underlying security, December 2025. So I didn't even have to change my charting if I didn't want to. Anyway, I didn't do that. I just did the short term, which is fine. And I did two different positions just to compare the two. I actually did a debit spread and a credit spread. And I wanted to see, again, based on the volatility, remember, volatility was relatively low. I expected it to expand, but I mistimed my exit, and I actually got out after it collapsed. So I didn't really take advantage of all the debit and the volatility that I could have. So I did the 406, 414 bull call spread. Why did I choose that? Because in the chart, 406 is the demand zone that I was looking for prices to bounce from. And it's not showing now, but on my chart that I just had here, it's not there as well. But 416 was a previous peak. You can see right there, 414 is where I had a little bit of selling pressure and imbalance. So I didn't expect prices to go up above that area. So that's why I did that. Are there weekly options on corn and soybeans? I'd have to check. If I look at, actually, I went too far. There it is. If I go to my FuturesPlus right here, actually, you can look at the contract directory and tool, but here it shows the monthlies on corn. And if I go to the contract directory, agriculture, corn, yes, there are. And you can actually look them up. I only had the monthlies being shown right now, but yes, you can if you go to the correct symbols. So you see there are weeklies, week 3, week 4, week 1, week 2, and then there's different symbols from Monday through Friday, but all the symbols are there. So we go to corn, again, there's all those weeklies available. And if you want to go back to soybeans, it's the same thing. It's under this contract directory. That's the best place to find it all. So yes, the answer is yes, there are. The question now, though, is there enough volume to trade it? Be careful. You need to be able to get in and out safely. Now, with these weeklies, because they're more thinly traded, you might not be able to chart them and trade them. Sorry, you might not be able to chart them and analyze them on OptionStation Pro, but you should be able to analyze them. For instance, let's see, we got soybeans. We'll go further out here, maybe in mid-October, for SDV5. I was in the right spot. Hang on. So I can go out and create a new tab and see. I don't know if it'll be under 4 or SD, but if you look up the symbol, let's check. I think it might be under 4SD. There it is, 4SD. That's it, 4SD, select, and there they are. You might be able to go ahead and, again, I can go for the specific symbol, but there's soybeans, yeah, 1040 right now. And you can take a look, I keep doing that wrong spot. Under contract directory, 4SD V5. V5 means the October 2025. They're not actually available for trading yet. So you'll see when are they available for trading? 1010. So I went too far. So I can only go to ones that are available for trading right now, and those are in the black. The reds are not available. So if I did 4SDU, that's actually based on the November futures, and they don't trade very long. You can see expiration 9/25, first available date was 9/11. So they only trade about, 2 weeks out? But yes, there are soybean weeklies you can trade. Simple answer, but long way to answer it. So getting back to where I was with the trade, again, I was looking for a bounce. I chose a bull call spread and a bull put spread as a credit spread, just to see the difference between the two. So I did the 404, 402 puts, as you can see here, and I did 406, 414 calls. I'm just showing you which ones I chose there. So I did a bull put spread, selling a put, buying a put, buying a call, selling a call for the bull call. That's it. I expected prices to rally up, and they absolutely did. So volatility, I already went through this with you. You saw the bands were constricting and volatility was low. And when volatility is low, it'll usually revert back to the mean. You can kind of eyeball the mean. You don't necessarily need to put an average in here, but you can see that we were trading a little below the average, and volatility will usually rise and often overshoot the average. That's why it's an average. It's in the middle. Prices swing both directions in trends. So again, this was leaning a little more towards favoring a bull call spread versus the bull put spread. And that's the other neat thing. You can look on TradeStation, OptionStation Pro, and the search feature, if it lets me on this, yeah, right here, I can look for, okay, I'm thinking about a bullish strategy. We can do limited or unlimited risk. And you can project what you think the volatility is likely to do and what the asset price is likely to do. And it suggests a couple strategies for you. It's nice. But just keeping it simple, again, relatively low volatility, expecting it to go up, I'm debit, right? And because I'm expecting prices to go up, I'm doing bullish. If I expect prices to go down, I'm bearish. And if the volatility was high, I'd be leaning towards selling. It's pretty simple. If I think prices are going sideways, then I'm going to do a neutral strategy. Simple enough. So anyway, this is what eventually happened. Obviously, it rallied up and stalled out on the 10th. It actually stalled out prior to that, like I said. So you can see that volatility did expand. Look at that. We went from low volatility to high volatility. We jumped from roughly 23 all the way up to 60 at one point for the volatility. That was a huge jump. And it would have been a nice profit had I been watching this and reminded myself to get out. But I got distracted and was trading my live accounts. Apologies. I'll try to do better. Hey, these are lessons we learned though. Okay. So what happened with the trade? This was the entry. You can actually go in and turn on the fills and filtered it just for these trades itself. On the call side, I opened it for 8. Now remember, the premium, you got to multiply whatever you see there by the point value. We're trading corn, so it's $50 a point. So 8 times 50, that was $400. I closed it for 13 3/4. So that was a profit of 5 3/4 points on the long call. The short call, obviously, that's going to be a loser. You're going to make profits on one, lose on the other, but you profit more than you lose. And what happened with this was 4.4 to 8.5, negative 4.1, or not point, but 4.1. It was 4 1/8. So basically, my net, I entered the position at 3.5. I exited at 5 1/8. And this was a debit spread. So I bought low, sold high, and I made 1 5/8. 1 5/8 times 50 per point is 81.25. I looked up the margin for that particular position. It was about $163. So I had about a 50% rate of return. Now it's interesting because you'll notice on the side here for the puts, I shorted the put 6 5/8, closed it for 2 1/4. So I made 4 3/8 profit. Not bad. Unfortunately, my long put also drew down. It went from 6 to 1 3/4, and I bought it back at that price for 4 1/4 loss. So overall, I only made 1/8. But the funny thing is, my margin on that was so low, I actually made a 94.7% rate of return. Now, that was when volatility had collapsed. And that's why, remember, I did this at the wrong time. I timed this incorrectly and exited on the 10th. Look where volatility is on the 10th, right there. So that's why my bear put spread had a better rate of return than my bull put spread, or bull call spread, excuse me. Bull call spread did not have as good of a return because the volatility collapsed. Now, let's look at where volatility is currently. It's up from there. Okay, originally we're looking at, on the day I exited, about what, 16, and we're now trading double that at 32. So let's see what the difference might be. If I go to the option chain currently, and again, we're looking at the 406 and 414 calls, right? So let me just write these down so I have them. 406, 414. I entered 8 and 4, 4, and then the 406, I'm sorry, 404 and 402. Just show you the difference that volatility makes. That's why you don't want to mess around with the volatility. People ignore that sometimes, and it really makes a difference in your trading, both positive and negative. So we have 6.5 and 6.0 for the entries there. All right, so now I go out to the option chain. There we are. And we're looking at corn, OZC. There we are. I was looking at the October options, so there it is. And good, we're good there. So I had on the call side 406. And I'll just use the last traded price, just keep it simple. 406 is now trading at 18.1, and the 414 is now trading at 11.1. Okay. The 404 put is currently trading at 3/8, and the 402 put is also trading at 3/8. So let's see what the difference is now. Again, I'll go back over here and use, I'll mess with this slide. It's fine. Let's see. Let's put that there, and on the long put, long call, excuse me, that was the 406. Now we're at 18.1. The call went to 11.1. 404 went to 3, and also went to 0.3. Little tool here, calculator. Come on, hit it behind the chat. There we go. And now you can see that too. So let's see, we got 18.1. I can just look at the spread, I suppose, because we got 18.1 minus 11.1. That's 7, right? I bought in at 3.5. So basically, that would have been a 3.5 profit right now. And the reason why is, well, volatility went up, right? And so did price compared to where I exited. I exited at the time, prices were around 420. Now they're another 3 points higher, almost 4 points higher, and volatility has doubled. So if I were to have exited today, holding on to that position compared to where I did get out, again, instead of 1.5, what did I just say it was? 3.5, right? I didn't need to use the math because 7 minus 3.5 is 3.5. So let's see, 3.4, or it's 3.5 basically, times 50 divided by the 163 margin. It's basically 100% rate of return, a little over 107. So that would have been pretty nice. Now, on this side, what do we have? The spread is basically zero now. I got in and sold it for half, and I would have made half. Or I'm sorry, that's not half, that's 5/8, 0.625. So 0.625 times 50, 31.25. Wait a minute. Oh no, that's not what I would have made. I would have made 0.625 times 50. Yeah, that was right. I had the wrong profits here. I did that wrong. That should have been 125. That's wrong. Excuse me. I did something wrong there. Hold on. December corn. There we go. My screen is incorrect. I didn't make that much on that one. And anyway, it was 0.125 times 50. Sorry, $6.25 was all I profited on that. And again, because, well, volatility collapsed as well, but divided by the $33 margin, 18.9%. That makes a little bit more sense. Oops, wrong way. But you can see that with the change in volatility now, there was a huge difference in profit. Like I said, this one was +7. Didn't have as, I guess we did have a bit of a change here as well, because now this was, I cannot type today. Sorry. There we go. So this would be current. And you can see how much of a difference that volatility makes. Instead of only making a profit of 1 5/8, now I would have made a profit of 7. So instead of 81.25, we had $170 worth of profit. So volatility makes a much bigger difference, especially on the long side, because I was buying a bull call spread, a debit spread. So we got to make sure that when we're monitoring our positions, we pay, and even getting into positions, we pay attention to this volatility. I entered with the bull call spread at the right time. I just exited at the wrong time. I waited until prices went sideways. We didn't give up a whole lot of price, not a lot of delta, but we got crushed on the drop in volatility. That's what gave up all that profit, where I only profited $81, and I could have had almost double the profits had I exited at the right time. Lesson learned, pay attention to the volatility and time the exits properly. I also probably should have set an alert when I got to the 414 and exited the position and nearly maximum delta as well, because had I done that, 414 was hit where? Right here. And volatility only rose a little bit, but I still would have had a good profit compared to where I gave a lot of that profit up because volatility collapsed. So another position I had is actually still open, although it probably should be getting closed out, I believe. It didn't work out the way I wanted it to. Oh, thanks, Rui. Miss you guys too. Unfortunately, I don't miss being there for certain reasons, but anyway, I miss the people. I do miss a lot of people there, especially students. But anyway, you guys can catch me here. Gold on a 4-hour chart. Basically, what was going on here is I was going to wait for prices to come down to a demand zone. I was actually bullish on gold. Again, you can see that we're above the 89 exponential moving average. Nowhere are we getting anywhere close to 50, let alone 40 on the RSI. So we got a very strong bullish trend. Basically, these divergences are only leading to small pullbacks before we go higher. So I saw a divergence that led to this pullback, and I'm thinking we're trying to go up again. We're losing momentum. We're probably going to pull back. This looked like a little double top that should get us back to that moving average, as well as the origin of this imbalance. So I figured, all right, prices have to come down before they bounce. Maybe I could take a chance and put on a bearish trade to capture that little counter trend move before we bounce. And I put in my long. But just in case, maybe I should play both sides. And I decided to do a straddle in addition to a bear put spread. So again, looking at the volatility, why would I be on the debit side? Again, look at volatility. It's down low. What usually happens when volatility is low? It usually expands and goes back to the norm, which would be probably around 35 in this case. We were trading right around 22, 23 for volatility at the time. The Bollinger Bands were narrow. We're in a very strong bullish trend. That's another thing. You can see inside the Bollinger Bands, when you're hitting the upper and mid bands only, you're in a strong bullish trend. You don't touch the bottom band in a strong bullish trend. It just doesn't happen because you're above the average. Anyway, same thing in a bearish trend. You should stay below the midpoint and hit the bottom band, never hit the upper. So irregardless, I was expecting volatility to expand, but I figured it might drop first before we rally up. And as we go forward, I decided, okay, I'm going to put on a couple positions here. And I did a straddle 36.85. And you can see I bought the 36.85 call, bought the 36.85 put right there. And I did December. I was doing December gold. I figured I'd do December as well. Once again, boing boing strategies. I don't know what that is, but I do know Steve's a good guy. Struggling with RSI. Again, it's something that I teach on a regular basis. I've got videos on it as well. Even on YouTube, I did a bunch of free ones so you can check out. But basically, I did the straddle just in case it rallied up instead of coming down to me. Figured I'd cover all my bases there. And because it's a possibility, we can consolidate. That was the other thing. When it goes back to the chart, instead of going down into demand, this is also a symmetrical triangle that's forming here. We're seeing consolidation. Consolidation often leads to continuation. The fact that we didn't actually correct and make a new low, all we did was pull back on the last divergence, tells me this is a very strong trend and likely to possibly break out to the upside rather than come down. And since volatility was relatively low, I decided to do a bull put spread. I also, as you can see, chose further out expiration, 75 days in this case. So that way I would have plenty of time and the time decay would not erode my delta if it was going in my favor as much. I also put in, as I said, the bear put spread, expecting prices to push down. I bought the 36.85 put and sold the 36.35 put. And I chose that second put simply because it's inside my demand zone. So I was expecting prices to push down into that demand. But obviously didn't work out. You can see that where we are now, prices rallied. We actually broke sideways. Technically, we broke down initially because I got in on the 10th and started going in my favor, but then we got stuck still sideways for a while. And then we eventually rallied. And that's where we are now at new highs on gold at 3,700. So the straddle call should be making profit. However, the put is losing money, obviously. And the bear put spread is obviously not doing well, is it? It's relatively low risk at this point. One of the other nice things is originally putting in the position again on 910, we had volatility that I thought was low, but unfortunately it got lower. And that's the problem. Sometimes it goes that way. You think, okay, it's going to go, volatility is going to go down. Or sorry, volatility is down. So you think it's going to rally. I was good on the direction, but once again, I was wrong on volatility. And that's where I'm in trouble right now. You cannot ignore that volatility. And you can actually do a little bit more examination of different volatilities. When you're trading equity markets, you can also look at the VIX as well. And there are VIXs for the NASDAQ as well as the Dow. So that can help you if you're trading those futures. So unfortunately, I'm in a down position, but the volatility is starting to rise close to where it was when I first entered, not quite there yet. And that's going to eventually help the position. So you see, I did the long 36.85 call, long 36.85 put. I bought the call at 104.9. And when I took a picture earlier today, this was the screen grab I did. You can see the call was trading at 86. No, sorry, 116.6. There's the long call. And I didn't see where it closed. We can actually take a look. Let's see, where is, oh, there we are. And we go to December. Oh, and it's even better now. That's a good position so far. Maybe volatility is increasing for me. So now it's at 120.5 or 120.4, excuse me. So let's update. We're now at 120.4. All right. So what is that now? 105. That'd be 15 and a half, right? I do the math right in my head? I think so. And I had bought the put at 105.7. That should be going down in value, obviously. And right now that put is 62.7. Now, earlier today, it was at 86. Oof, that kind of got worse, didn't it? Oh, hang on, I went the wrong spot here again. I'm sorry, I looked at the wrong put. Okay, never mind. It's right here, 84.6. It's the right put right there, 84.6. So, yeah, it got a little worse. So what are we doing here? I'll cheat. It was 105.7 minus 84.6, 21.1. And I'm still in a losing position. Again, I keep doing the wrong page. So 21.1 right now. So the straddle spread is not doing as well as it should. It's doing what it's doing. That's the thing, because volatility and price. So even though prices are moving in my favor, it hasn't moved far enough, but I still have plenty of time left, obviously, on the straddle. So I'm not too concerned. It was, let's see, 210. Where are we here? 120.4 plus 84.6. It's 205. Oops. So currently 205. What's your decimal? That's 205 even, right? Yeah, 205 even. So actually it got better since earlier today. I am only down 5.6. 5.6 times 100 points is $560. So that's not too bad as of right now. Now, why did it get better from earlier in the day? I grabbed the 6. Again, prices moved a little bit further from earlier in the day. Go back to the live TradeStation chart and see exactly why did it get better. Because I took this picture earlier in the day, and now, if let's say I go to a 15-minute chart, you can see towards the end of the day what happened. Volatility started rising a little bit more, even though prices didn't really do much. I don't remember exactly when I took the picture, but volatility was going up today. So that was helping out my position because, again, it's a long position. I bought the call and bought the put. So my straddle spread loss is getting better and prices are moving in my favor for the call. So that's still good. Unfortunately, right here, we did the bull put spread, bear put spread. Remember, though, that's a debit spread. So volatility increasing actually does help me a little bit. Once again, when I took the screen capture earlier today, I was in a negative $330 position. Let's see where it is now, out of curiosity. So we're going from, where are you? There we are. The long put was at 86. Now the long put is at 84.6. So that got a little worse. I'm just typing it in 84.6. And the short put is now 62.8. All right, go back, make sure I use the right pages. There we are. And let's see, we got 105.6 minus 84.6. So I'm down 21 on that, unfortunately. Keeps going the wrong direction. And we have 80.1 minus 62.8 is 17.3. Oops, there we are. So 17.3 minus 21 is 3.7. So that one got a little bit worse, but not by much. So now it's down 370. And we'll take a look and see how this comes out. Obviously, in our next session, we'll get together because we'll still have plenty of time before that happens, before this expires anyway. I've got to remember when our next session is. It'll be coming up. You'll see it on the calendar eventually. But yeah, this one is not in my favor, which is interesting because, again, I bought the 36.85, and looking at the chart, you'd think, wait a minute, Brandon, we're at, oh, this is the wrong chart, GCZ25. That's why. Nobody said anything. Okay, so during the day, actually, the volatility dropped at the end of the day. We're at 37.21 right now. So I ended up getting in, let's see, that spread, let's go to Option Station Pro, GCZ25, and go to the option chain. There we are. And which one do I have? It's not even showing this one. I have the December options, which are 70 days away. November 24th. Oh, it's these right here, November 24th. That's it. What the heck? That's not showing me the right strikes for some reason. I'm not sure what's going on there. That's one of the problems. Again, you're not supposed to be you can't really trade it on this platform. You can do analysis on this platform, but for some reason, it's not giving me the right information here for that OGZ25. You saw the strikes were way, way off. Sometimes you could do it, sometimes you can't. If I were to go out to the ES or NQ, for instance, NQZ25, yeah, oh, it gets screwy after the market's closed. That's what happens sometimes. Yeah, it's not getting the right feed. But here, I've got all the options. But yeah, now I can see the actual pricing. But yeah, sometimes it happens. So I apologize. Got to do it during regular hours to really do the analysis. What I was trying to show you was the option chain. I'm sorry, the risk profile, and to manipulate it a little bit. But I can't do that currently, unfortunately. Oh, I do have a couple other positions. How much time we got left? Not a whole lot. I'll be able to go over the other positions probably next time as well. But let's see. I did have. I go back to open positions. I do have the platinum. You see right here, PO. I ended up doing a couple different platinum positions. One was, let's see, find my file. There it is. And nat gas as well. But platinum, I was looking at that, and I did kind of an exotic one too. I did what's called a jade lizard. But originally, the first thing I was looking at was right here on platinum, and created this position because look at what's going on with platinum. It was just going sideways. And this was between 1303, 1374. And that's on the daily chart. If you go down to the 4-hour time frame, and again, pretty much going sideways. We take a look at the current contract, the way it looks now. Let's bring it up on TradeStation. PLV25. There we are. Sorry, just checking something real quick. You can still see there's a 15-minute. Let's go to the right time frame. I'll go to the daily. We are still relatively sideways. We did have an initial spike and move out. You saw a little bit of a jump in volatility, but for the most part, volatility has really died off, hasn't it, compared to where it was? And I originally, let's see, if I go back to, it's getting ready to roll, absolutely. But currently the position I have, again, I was initially looking at this and opened an iron condor position. This is the screen capture I took for the iron condor on August 21st. So I've been in that iron condor for a little bit here, and we can take a look to see how it is. I have my average sell, average buy. I can actually look at the fills as well. If I go back to my platform, and right here, I have, nope, I've hit it. Close that out. Here it is. And right here, August 21st, I actually have it open. And I can do a little filter here under contracts. Just look at PO. And I believe that should be the iron condor. And there are my fills. Just verify. I take a look at that iron condor open position picture that I took and just make sure. Average open 30.8, 32.7. Yeah, that's right. So it all matches the picture I took. We can take a look at it currently and where it's sitting. So all these prices are here. They're all correct. Basically, I did a bull put spread, 1300, 1290. Unfortunately, I think the calls are in trouble, 1365, 85, 1375. Where are we trading currently? Yeah, we're at 1400. So we're above that area. Unfortunately, initially, you can see we're trading right in that 75, 85 area, and we broke out. And that's what's hurting me. The nice thing is that volatility has dropped. And of course, time has passed by. That's helping, but those calls are actually in the money as of right now. So let's see how bad it is at this point. And I can also possibly roll over to the next month to see if I can maintain that position if it goes back in, depending on what price is telling me to do. I'm not just going to do it just for the heck of it. So there's the open position. And again, I've got another position as well. I'll talk about that later. If we take a look at the chain, let's see what our current prices are. That is PO, and it's the October. I also have January contracts as well, what's called a jelly roll. I'll talk about that in a moment. But, oh, come on, get out of there. October, there's the chain. And let's see, let's do it like this. Notepad. Let's bring that up real quick. Wait, no, cancel this. New tab. There we go. Just trying to get something clean to type on. There we are. It's gotta be difficult, doesn't it? So what was I doing here? Open position. Just keep it nice and simple. And we have iron condor call 1385, and that was entered for 32.7. We have the call 1375. Again, those are both in the money, but let's see what the price at currently. Because again, time decay has helped me a little bit there, and that was at 30.8. And then we have on the put side 1300, and that was 13.1 average sell. And I had to put 1290. That doesn't seem right. I think it must have screwed up and did market orders because my average buy here is 14.6. All right. So that's where it was. And now you can see the open position right here marks those calls, and I'm going to need more puts. Not that much, but there are the puts. So we're looking at current pricing, and it might get some funky pricing, unfortunately, pre-market or post-market like this. But the calls are currently trading at, let's see, the 1385 is at 40.8, and the 1375 is 48.2, and the puts, the 1300 is trading at 0.2. That's basically worthless. And that one is also 0.1. So that's where we are right now. Again, unless it falls back in, and I still have time left on these options. Actually, not too much time left. When's the expiration on this? Nope, 2 days. This one's just going to expire in the money, unfortunately, and get a full loss on those. As you can see, not doing too well. The call that I bought, the 1375, has gone up to 48, but unfortunately, it's almost flat, isn't it? If I exit now, obviously I have to wait until the market is open. There's it. It's about closed right now because the initial spread is I sold the 30.8, bought the 32.7. So the spread was 1.9 here. And the calls on that side now, I'd have to buy it back for 40.8, and 48.2 is what I could sell that one for. That's 7.4. How does that make sense? Did I make a profit on this, even though they're in the money? Just because of the volatility change, perhaps. Yeah, we got quadruple witching on Friday. That's right. Because we got single stock futures, index futures, options, and index options all expiring the same day. So quadruple witching. Used to be triple witching. Then they added the single stock futures. Interesting enough, with the volatility, it looks like I actually might have a little bit of a profit here, right? Because I bought, let me do this right. I sold this. Oh, no, it happened. Let me do that. Doing this wrong. There we go. No, I sold and I had to buy it back So that's a negative 7.4. That's right. So I'm actually down again. So that makes more sense that I have a loss because it is 7.4 minus the 1.9, and it's 5.5 times platinum is $50 a point, 275 for the loss currently based on the premiums. So probably best to do that is just take the loss. Now on the other side, again, I sold the 1300. I could buy it back for 0.2. I bought for 14.6. I'd have to sell it back or buy it back. Sorry, sell it for 0.1. So that looks like a losing position as well. Those I'll just let expire worthless and just collect the premium on that. So the only one I really have to deal with is on this side. Instead of taking the full loss, because I had an adjustment in the volatility, I actually don't have to take a full loss there, which is nice. So I have run out of time, and we'll continue with the other positions, talk about those when we come back another time on our next session. So I'm going to turn it back over to Jesus. Thank you again for having me. Hopefully I gave you some insight on some of the option stuff that's going on. And again, if you got questions, education@tradestation.com. You can also get a hold of me through that as well.
Excellent. Thank you, Brandon, for your time. Yes, it's very interesting when we get an opportunity to look at the markets and see what type of strategies could have worked or the ones that didn't. It's always great to hear you, Brandon. Thank you so much for your time.
Yeah, thank you.
Everyone, yes, education@tradestation.com is our email address. Feel free to send us any questions there. I am going to finish the presentation with the same invitation that I extended to you earlier or at the beginning of this presentation, the in-person masterclass. Please click the link. And don't forget that we have a promo code that will give you $100 off. The promo code is options100. So if you have any questions about the event, you can also reach us at education@tradestation.com. Let me just put that here in the chat, just in case you want to jot it down. Thank you so much for your time. Have a wonderful afternoon, and I look forward to seeing you in one of our future classes. Great. Have a great day. Bye-bye.